Jonathan, you want to come on up with me? Amazing. Well, we are starting off the morning. I'm excited to see a few people trickling in now that everyone's had their coffees. We're starting off the morning with a topic that I think is super interesting, and also I know a lot of people who are here at the conference are interested in, which is how to succeed as an LP in VC. I'm Eleanor Warnock. I'm deputy editor at Sifted. Sifted is an FT-backed publication that reports on startups, scale-ups, and VC in Europe. And I will be moderating the conversation today with Jonathan and two other people joining us on this. Yay, we have everyone. Hey guys. Hey Ertan.
Hi.
Hi Ian. How are you? Amazing.
Good.
Awesome.
Doing well,
Well, I
thanks.
thought it would be really nice if everyone could just kind of start off with a quick introduction of yourself and kind of what you think you're bringing to the conversation, what your perspective on the conversation is today. Maybe Ian, do you want to start us off?
Sure. So, hi, I'm Ian. I work with AXA Venture Partners. We're a 1 billion euro plus fund that's solely focused on VC. We have an interesting structure at the fund whereby we have a GP and an LP within our platform. So we bring some quite interesting perspectives from just being a global organization and quite unique in the way that we operate. Myself, I've been here for just over 2 years. Joined just before the pandemic hit, so just in time for all the fun times. And before that, was working a corporate finance in London. Spent some time in the UK studying. Grew up around the world when I was younger. Spent about 10 years in the US, which is why I have this weird accent because I'm actually half French, half Scottish as well. So it's a weird mix going on there. But yeah, excited to be part of the conversation. Nice to meet you all.
Nice to meet you. Jonathan, maybe we'll jump back to real life.
Sure. Hi everyone. And I'm Jonathan Hollis, one of the partners at Mountainside Ventures. And what we do is we work with founders and funds on their next raise. The core business is we advise and partner with early stage companies raising typically 1 to 15 million. And on the side, we also look to support emerging fund managers raise the next fund. And so we organize events, we run reports, we run workshops with the mission of promoting more capital going into European VCs and ultimately then into startups. And some of the areas that I'd like to bring today and discuss, we ran a report last year and 60 LPs contributed in specifically what they looked at when it comes to VC investing. And so we've got some data and some stats to share. The second aspect is we speak to a lot of funds, specifically emerging funds. The conference we're running in September, we had around 250 applications on the VC side, and so we've seen lots of decks, and some good, some not so good, and I'll be also discussing hopefully some of the trends we're seeing in the space.
And Ertan, last but not least.
Yeah, I'm the founder of Multiple Capital. Multiple is a fund of funds, a very traditional but micro fund of funds that invests in other micro VC funds. We are managing now roughly something like $30 million and have invested in 45 VC funds with that money. And most of the funds are relatively small in fund size and invest extremely early. And we've done this or started doing this in Europe mainly, and now it is becoming more and more global. So we have, I would say, 1/3 US and rest of world, and 2/3 still European niche managers. Myself, I'm living in Frankfurt, Germany, born and raised here. Just lived 1 year in London, don't have the accent, never could adopt the bus driver's London accent. But other than that, here's home with my family, and yeah, we're doing this from here everywhere.
Maybe we could just kick off the conversation, Jonathan, with you talking a little bit about what changes you've seen, trends you're seeing in LPs investing in VC in Europe recently.
Sure. I think one of the trends that we've seen is We all know how difficult it is raising from LPs, especially in Europe, and still the government is still very involved across Europe. And so one of the trends we've seen is actually other VCs investing in VCs. And so it's, so maybe some of the mid to top tier VCs who have raised fund 3, 4, 5, and they're becoming, and they're creating a separate fund-to-fund vehicle. And I think one of the reasons they're doing that is to access earlier stage deals. And so if you're a VC investing at Series A, Series B, Series C, you might want to create a vehicle to invest in a dozen to maybe 20 seed stage VCs in order to get the information rights and access to the earlier stage deals. So that's one big trend we're seeing. Another trend is the rise of emerging LPs. We all talk about emerging VCs, but actually there's a rise of actually founders or individuals investing directly into funds. And that might be into listed vehicles like the likes of Augmentum or Forward, who have recently in the last couple of years listed in London, which means that individuals can actually access some of those funds, or it might be exited founders that are looking for investing into some of these funds, which typically a minimum ticket size for many of them is 1 million, and now there's a bit more of a democratization of VC, and individuals can actually invest in those as well. And then probably the third change. And the third trend is, I'm sure we'll get to a bit more detail, is just the rise of ESG and impact investing.
Super interesting. Yeah, definitely, especially with the founders becoming LPs as well. I think the VCs really appreciate being able to kind of bring them in sometimes, even help them win deals, and yeah.
Yeah, it gets a bit confusing sometimes when the founders are LP of a fund, and then the fund might be an investor in their company. So we've worked with some of the companies that we've worked with. There was one that raised a couple million last month, and the founder was an LP in one of the funds that ended up investing. So it gets a bit complicated, but I think it can only be a good thing, because it means that founders can empathize more with how VCs operate, and if they can understand more about how VCs work, they can actually build a better proposition for them.
Definitely. Ian and Ertan, I want to go to you both and just ask you, what do you think, from working with many different institutions, what does good look like for an LP? What practice? And maybe also speaking from across geographies as well. Ertan, you were talking about, your kind of global focus as well. You want to start us off?
Ertan, do you want me to give it a... Yeah, okay. Yeah, to that last point, Eleanor, I think it's quite interesting because, the past 4 or 5 years, venture has gone through an immense amount of change. This was an industry in the past where, it was a lot of focus in the US, some stuff going on in Israel, things going on in China, but it wasn't, exactly truly a global asset class. And over the past 5 years, that, perhaps a bit more, it's changed immensely, where now the landscape has evolved into, is truly a global asset class, where you have, geographies like Europe, you've got Southeast Asia, you've got India, Latin America. It's all coming into the play, and we're seeing more and more high quality founders come out of all these different regions around the world. So being a good LP or being a successful LP, I really think you do have to have kind of this global lens. Even just understanding the fact that US managers are moving around, coming to Europe. Asia managers coming into Europe, or Europe managers going to Asia. We're seeing that more and more. So in order for us to be able to kind of understand what good looks like in terms of a good manager, good strategy, good outcomes, good performance, all those things, you really have to look at it globally. A second point I'd mention is, perhaps having kind of a clear USP as an LP is actually becoming increasingly important, because providing capital is one thing, but that's becoming more and more commoditized, And so for us at AXA Venture Partners, that's the hint is in kind of the title, but we're backed by one of the largest insurance companies in the world. Just to kind of give you a sense of scale, there's 150,000 plus employees, 50 plus countries covered, and they have an annual IT spend of like $3 billion. So it's a large organization with a huge network. And so when we speak to managers, one of the things we can offer is very interesting introductions to people who can serve as customers for their portfolio companies, or even just providing thought leadership when it comes to anything insurance, fintech, all those things. So within a phone call, and that resonates very well with GPs for us. And then in terms of just kind of a focus, on the point where we were talking about venture, I was talking about venture becoming more global. It's also becoming it's a much larger asset class today than it used to be. So being very sort of VC focused can actually in itself be kind of a unique selling point. Being able to have those kind of in-depth insights and knowledge on the asset class specifically. I mean, just to give you a concrete example. So, I speak to LPs who, they're doing stuff in private equity, venture, all the different asset classes. And those conversations tend to be a little bit more surface level than if you were just speaking to someone who's spending 100% of their time on venture. And that also kind of reflects in the conversations you have with GPs. So just having that kind of depth of knowledge is really important. And then lastly, I'd say, just having that broad network within the industry that you can leverage to reference those managers and understand from the inside by speaking to those people what great looks like. And if you combine all those four things together, I think you have all the pieces to become a good LP and make the right choices when it comes to manager selection.
Very interesting. Ayrton.
Yeah. So I agree with Jonathan on the two new, let's say, LP groups entering the LP world, which is, VCs, other GPs doing more and more investments in other VC funds, especially in, let's say, feeder funds. And some of them even setting up own fund of funds and doing it even more professional and investing, like Molten, for example, very systematically in seed funds. Others doing it less professional as GPs, individually investing, which I still really respect, because I think they're believing in the ecosystem and they're putting money into other GPs as well, and that's a good sign. The other new group that I also see are founders. So founders who exited, founders who had secondaries, who believe in other GPs, who sometimes invest in their own GPs, like in the VC funds that invested in their companies, but very often also invest in other GPs, right? So in first-time managers that they know, other operators they knew from the past, who are becoming GPs now with the first funds, and they are raising a lot of money from founders today. So that's a new group that I see is very active. It works well for small funds, of course. If you're a very tiny fund and you have a good network of founder LPs or other founders, you can really raise significant money in terms of fund size for yourself from these groups. Of course, as soon as you become a slightly larger fund, it is very difficult to raise enough money from those groups, because still, so far as I can see, the tickets are relatively small from those groups. But still, it's a very good sign. It's even for us as a fund of fund, we see now more interest from these two groups compared to the initial target group that we had, which was family offices, right? So we always thought, okay, we will help we call it unsophisticated family office to get access to a super diversified, well-selected portfolio and venture, like an allocation product. That was like the initial idea of Multiple, to give a family office in, I don't know, Cambridge or Manchester or Hanover or Kassel, those smaller cities where people don't have really access to VC funds and don't have the mindset of understanding which funds to back, to give them an allocation product. Now we see it's a completely different group that shows interest in a kind of fund like ours, a fund of fund, and it's more the sophisticated people, which surprises us, right? So it's more the sophisticated other GPs and sophisticated founders who could invest in other VC funds as well, but who understand even for them, investing in 20 or 30 funds globally is a big stretch, right? And this is like the new group. Another, of course, new group entering the LP market is more and more fund of funds now also in Europe. It's not, I think when we started back then, we were one of the very few fund of funds doing VC only in Europe. Today, there is probably a dozen, if not more. I stopped counting But there are a lot of fund of funds in Spain, in Germany, in the UK, I guess. Some of those more institutionalized funds, let's say sub-funds of the main funds, of the main GPs, VCs, doing more and more fund of fund investments. Tiger announcing 1 billion, to invest in micro VCs. So there's a lot of new entrants who are professional but still raise capital themselves, some of them at least, but who want to enter that market of investing in VCs. Still, having mentioned that, I still see a lack of the other groups that should be part of that ecosystem, which is again the kind of institutional money and family offices who still are not, in my view, not really actively allocating into venture European wide or globally. So many of them, if I look at the German market, which is the closest to what I'm looking at, many of the institutional investors in Germany and family offices in Germany, and I'm talking here about 500 plus family offices, and from those, maybe 2% are actively investing in venture, and 98% have no venture allocation at all. And if they have, it's maybe one fund or a handful of companies in Munich where they are based. That's not really a venture allocation. So that's the thing that is still, I would say, a big lack or gap in Europe versus US, Asia, where a lot of family offices very actively build venture allocations. A lot of institutions like endowments, for example, have 20% venture allocation in a super diversified way. So that is the thing I think that we still have to develop in Europe, where it's not enough to have only founder money and other VCs money, which is not typically really allocating huge amounts of money, but it's more a small ticket to have a feeder, feeder fund giving you more deal flow. It's a different thing. And sometimes, backing a friend or good guy that you like. It's a different thing from a family office that could deploy 10 million over 3 years and then another 10 million in the next 3 years, et cetera, et cetera. So that's something that I'm still missing, I would say, in the current ecosystem, and that we still have to develop.
And what do you, Jonathan, maybe you can comment on this. What do you think is holding investors like family offices back from allocating more to European VC?
Good question.
It's like the $1 million question. If we can unlock this,
Yeah.
it's like.
I think the main issue is probably that when you're, I think it's operational. I think as a and this we talked a bit about this yesterday. If you're a company, if you're a founder, and you're raising from VCs, the job of the VC is to speak to you and diligence you. If you're a VC and you're raising from a family office, the family office often just doesn't care. That it's got, in terms of its AUM and its wealth, it's likely going to be investing sub 1% in that asset class. And so if you think about, the operational and the day-to-day of the life in a family office, it's completely different, of course, than the life of a VC. Because their day job isn't the sourcing and diligencing deals. And therefore, as a result, you have to try extra hard, and you have to speak to the right decision maker. And often, we see a big trend in if the family office isn't interested in that particular sector, if they haven't got a background in it, if they haven't, if it's the wrong day of the year, wrong day of the week, they're just not very interested. And so I think one thing that could look to improve it is to just try and narrow the focus down into meeting and engaging with family officers that have a background and that you can build more engagement. Because I think operationally, if I was a family office and I had 1 billion to invest, would I spend a lot of time speaking to 20 different VCs when it's 1% of my wealth? Probably not. However, one trend that we have seen is the rise of more multi-family offices, which operate much more like an institution in terms of processes. And so that's one positive sign, that actually if family offices get together, then they can have a dedicated person who's in charge of sourcing and investing, and then it gets a bit easier. But in answer to your direct question, I'm not sure what the answer is. I can just see that the multifamily offices are easier, and if you can pitch something that is relevant to them, then that's even easier. I had a conversation last week with the family office, and the first conversation was, what do you look for? And the answer was, anything. We're opportunistic. Every family office is opportunistic. Well, I mean, why? Because it's the principle. Why would they not be? And then the second question was, actually, what are you like? You're going to invest in? What have you invested in? And then the conversation was, well, actually, I exited a fintech company, and I'm probably more likely to be interested in fintech. Then you're like, okay, fine. Well, you're opportunistic, but actually, you're probably only going to really invest in fintech. Then it's like, okay, well, how many assets do you have, and how much do you look to invest? And then you realize that, if they've got a few 100 million looking to invest, they're not going to worry or care about 500,000, 1 million, 5 million euros. And so then the next follow-up is actually they're going to be interested in investing in large amounts of money. And so although on the face of it, they're opportunistic and invest in anything that they're interested in, actually upon a deeper dive, it might be later stage and a specific sector.
Interesting. Ertan, I wanted to go back to you too and ask you for your opinion on why you think that family offices haven't allocated as much to European VC. And I wanted to also dig into what you were talking about around this sophisticated investor versus the not sophisticated investor. I thought it was very interesting that you characterized founders who maybe they're making their first LP investment in a VC, but you described them as being sophisticated. I would love to hear a little bit more about that.
Yeah. So it's my favorite topic, by the way. So I'm happy to talk a little bit more in length about it. But to answer very quickly your sophisticated, unsophisticated answer, I think the sophistication of the founder is at least he knows the names, he knows the model, he understands how they invest, he understands what a seed stage fund is. He understands the different verticals of venture investing. He understands the let's say the basics, and he has access, he has a network. Right, so he knows the names. He has maybe spoken to them, pitched his company at some point, and spoken to 50 VCs. So he has met them. He knows how they think and where they are and why venture is venture. So that's the sophistication part. Okay. Same, of course, for GPs of other VCs. Of course, they know their business and they know roughly. Still, I still think that even GPs are not the level of a professional LP because it's not their day job. Right, so they're not talking to hundreds of other VCs from an LP perspective. They may be talking from a co-investor perspective, or they're talking from getting deal flow from a smaller fund or earlier fund perspective, but never from an LP perspective. So most of the GPs allocating to other VCs have not looked at hundreds or thousands of funds and then selecting 5. It's typically the ones that they know, that they like, and then they do a ticket, and it's most of the time local. So the 5 things that I recognized as the problem why family offices are not really able to, let's say, allocate at the moment actively in that market is, first thing very quickly, is education experience. So they're not really educated in the venture world, in the venture ecosystem, and so the basics, even let's say a closed-end fund, how that works with capital calls. Sometimes we have to explain family office because they've never done a closed-end fund. They've never done capital call management, etc. So that's the basic things, education. Experience is the other thing. They've never invested, let's say 10, 15 years ago in a fund and seen returns, seen that this evolves into a very interesting thing. Not only investing in a fund, but let's say several funds to see how a portfolio evolves. So that's the missing part, or let's say the first part, education experience. Second is family office, as Jonathan said, they're doing everything. They're opportunistic, but they're not doing only venture. They're doing real estate, equities, bonds, private equity, hedge funds, any kind of infrastructure products if they're big enough. So they're doing everything. And because of that, they have a lot of gatekeepers between the family offices and the target, let's say, companies or funds or fund of funds even. The gatekeepers are banks, sometimes also multifamily offices, by the way. So multifamily office, nothing else, in my opinion, as something like an intermediary between the final money and the products that you want to invest. Some of the multifamily offices are very professional. Others behave like gatekeepers and banks. And if you look at that banks can have experience again on education and equities, bonds, in those standard markets, but most banks don't understand venture again, right? So they're not the right gatekeepers to select for the family office the right funds in venture. And that's, I think, a second, let's say, bigger issue in the European ecosystem. Third is access. So education gatekeepers. Third is access. How do you access? Even if you want, let's say you are, a family office somewhere, and you wanna build a venture portfolio. It's not like that you can go on to Bloomberg and compare the funds and then select the best funds and call your bank contact and ask them, hey, we want to buy that and that and that, and then in 1 year maybe sell that again. So that's not happening in venture. So venture is a very intransparent, inaccessible market. So for most family offices, it's very difficult to build that knowledge and access to understand how to see, not even select, but how to see the market, the universe. And the fourth thing I mentioned already is transparency. It's an intransparent market. It's not like that you can see and have that. And the fifth thing is also something that Jonathan mentioned. I would say they don't have a clear mandate, right? They don't have we as a fund of fund in venture, we have a clear mandate. We have raised money for venture, and we have to deploy that money into venture in a specific time. An opportunistic family office has no clear mandate for venture. So you might pitch them, it might work. You might pitch them, they might say, come back in 3 years. We have time. We don't have pressure. We don't have a mandate to invest in venture. I think that's the 5 things that are, in my opinion, the biggest stoppers from family offices being real allocators in venture. And to just one sentence maybe to how to do that or how to improve slightly. I think at some point they have to start, and with the start, ideally they have to create something like an internal mandate. Something like, for example, we have to allocate or want to allocate 5% in venture over the next 10 years, right? And then they start to allocate. They start to build up. They start to educate themselves, ideally internally if they are big enough and have people. If not, work with partners who can help them, to build that allocation. But it should be not super opportunistic. It should be a clear mandate on deploying or allocating a percentage of their wealth into that asset class. That's, in my opinion, the right way to benefit long-term from venture and to build their venture allocation in a family office or small institutional investors. The same thing.
And I feel like it's such a shame because there's also so much beyond that capital that family offices can potentially contribute as well. And I feel like that links really well with a point that Ian made earlier about this communicating your USP and communicating that you are, you can contribute so much more than just capital, right? And I'd love to hear from you, Ian, a little bit more on that point. Like, how should LPs think about that, extra stuff? What is the universe of things that they should be thinking about providing as an LP beyond just money?
Well, to be honest, it's a good question. So I think it really depends on a lot of things. I mean, I've already mentioned for us, it's kind of having that network behind us of people that we can make a phone call to in a situation where maybe a manager wants to understand better what's going on, in the property and casualty insurance space for a particular investment that they might make. So I guess one of the things is kind of just leveraging that network that you have and understanding how that can contribute to a conversation between you and a GP in a different way to everybody else. And whether that's through, networks that you've built through different industries, different asset classes. I mean, you just got to do what you can to kind of bring that to the table. And then just also, I think, from our point of view, and this is something that takes a little bit of time, as you spend time looking at a lot of funds, a lot of managers, you accumulate a heck of a lot of data. And I think just having kind of that data-driven mindset when you approach any investment strategy is important. But in the case of an LP, if you can bring to the table a set of insights that you've derived through an amalgamation of tons and tons of data. Like, so let me give you a kind of a concrete example of what we're doing. So one way for us to have better conversations with our GPs and GPs that we want to speak to is, we've seen in detail over 1,000 funds, right? And when you get information from all those different funds, you have a bunch of data on companies, you have a bunch of data on performance, you have a bunch of data on sectors, stages, all those things. And a lot of LPs, they'll have that sitting in their system somewhere, but they don't really make use of it, right? And so what we decided to do was to kind of put together a sort of proprietary kind of database where we can quickly pull insights from all that data. And a single GP will only see, they'll see a bunch of companies, but they don't see hundreds of other funds are seeing at the same time. So if you can bring that kind of top level view of what's actually going on within the industry, and leverage that to have really meaningful conversations with GPs, that is a huge USP. That is a huge game changer. But that takes time, and that's effectively that's IP that you're building over time. The other thing I'd probably say is, next to data, is just also just to be honest, if I go and speak to a GP, I often ask, what can we do to be better LPs to you? And they often say very simple things like, you guys see tons of different styles of reporting, for example, right? If you know what a good report looks like, or a good bunch of reporting that's issued to you looks like, and we're not doing it as well as other people, give us feedback. So just even giving feedback on simple things, things like reports that they give back to their own LPs and how to improve those things. That's helpful, right? So just having that constant dialogue and those constant touch points with those people, GPs tend to really appreciate. I think we get really caught up in all the work that we have to do, being at our desk, crunching through numbers, whatever we're doing day to day, but just remembering to have those touch points and have constant conversations with people. They'll remember you and they'll appreciate it. So yeah, that's what I'd summarize it as.
And I think you make a super good point, which is that LPs can be such a strong force for helping the industry professionalize and pushing the industry forward, right? And I think one area that we're seeing that really come to the forefront is around ESG, right? LPs coming forward and telling GPs, okay, you need to tell us what your portfolio companies are doing on ESG. You need to be reporting about diversity. You need to be reporting about the economic or the environmental impact of your fund and then also your portfolio. So I'd be really interested to hear, maybe Jonathan, you can kick us off on this, how you see that ESG conversation evolving between LPs and GPs.
So I think we're certainly seeing it evolving over the last decade. I think in the analysis that we did, 2/3 of the LPs mentioned this was something they were looking to do more of, and I think it's clear for those in the space that the LPs have a lot more control and power, and could and should be doing a lot more. I think on the VC level, I think it's still not very clear what ESG means and what it encompasses. We were having a workshop last month with a number of portfolio companies, and it's part of the ESG network. And ESG for founders might just be things like avoiding taking the plane where you can have a video call. It might be a cycle to work scheme. It might be a whole bunch of things that you'd expect are now pretty common, but still fall under the ESG umbrella. And so I think one of the issues we've still got within the ESG space is defining exactly what good and what the criteria looks like. But we are also seeing, of course, a lot of LPs pushing for this more. Some of the LP conversations we've had recently who specifically look at impact, we've also noticed a bit of a trend from those LPs, where before they might be investing specifically in impact funds. Now they're looking to invest in impact-driven or impact being part of the thesis. And so I think this is probably as a result of wanting to, of course, invest for financial returns and for profit, and seeing the data shows that actually an agnostic or specialist fund where impact isn't the core focus, but where impact is embedded within the thesis, is likely to do much better than one where it's either not for profit or where impact is the forefront of their thesis. And so I think that can only be a good thing, because it means that if all funds have got impact in ESG as part of their armor and part of the thesis rather than at the forefront, I think that's a good thing for the ecosystem.
Ian, how have you seen GPs become more sophisticated around ESG, and what do you think LPs can do to help push that forward?
Yeah, it's good that you bring up the ESG point, because we internally went through a pretty detailed conversation about 6 months ago about what we should do about our own ESG strategy. So in doing that, obviously talking about the data stuff, but just having access to all the different funds, just seeing what best practice looks like in the industry, we were able to kind of come up with a actual action plan and ways to meet. So actually set of objectives and an action plan against those objectives. And the way we structured it was very much aligned to the UN Sustainable Development Goals, which is one way we've seen people do it. But just before I kind of dive into that, I just want to say that it's actually quite interesting to see how different parts of the world within venture operate with ESG. At least from the research I did, it seemed like, in the US, and this may be anecdotal, so maybe some of you guys will disagree, but in the US, it seems like the policies there can be fairly underdeveloped compared to what you see elsewhere. In Europe, it felt like there was, the policies around ESG were more developed than in the US. And then in Asia, it felt like even more so than in Europe. So it was interesting to see that kind of difference between how managers operate in those regions. So you asked, what are people doing? To John's point, like it's hard to see what the criteria actually is. The way we've done it is we've said, let's look at E, S, and G separately, those three aspects. For the E point, we're at the moment we're looking to engage a third party to perform a sort of like emissions report on our own footprint and how we and through our operations internally, but also for our portfolio companies on the GP side of our platform, with the aim of kind of understanding how we can improve those processes, reduce those emissions from us internally, and also provide kind of insights to the portfolio companies that we work with to help them kind of address the way that address ways that they can reduce emissions themselves. So and with funds, I suppose you could do the same thing. The biggest contributor to environmental impact there is often travel. So to John's point, maybe taking more board meetings on Zoom would be helpful. But on the S front, in venture, there has been kind of everybody's aware that there's a lack of diversity at the leadership level, and gender mix and even other types of mixes, just diversity generally. So things we're doing internally to kind of mitigate that is, putting unconscious bias trainings in place, ensuring that we contributed to the community around us. So we're setting up schemes where we have matching mechanisms for donations or even volunteer work that we do in areas near where we work, and even just kind of tracking internally. I keep pushing this point, but on the data point, tracking internally the kind of diversity within the funds and the companies that we look at, and using that not as a primary decision maker for making an investment, but as an indicator of, okay, is our portfolio over-indexed on just male teams, or do we have a good mix of male-female teams and the people we back? But it starts with the data, and then just kind of leveraging that data and bringing it forward to all the people that we work with, the partners, the partnerships, the GPs, and the portfolio companies. I'll stop there.
And what's your view on this?
So two things. One thing is, of course, I see a very similar development when I speak to globally GPs and also founders. I just one anecdotal meeting I had a week ago with a Turkish founder who did something in quick commerce, and when I mentioned ESG and SDG, he was just not aware of it, right? So you've never heard of ESG or SDG. And that was quite shocking for me at that moment. But I think that's just a trend at the moment. And in some areas like Europe, ESG and SDG goals are much more important and much more looked at, but also driven much more through the public institutional investors like the EIFs of this world and KfW and BBBs of this world. I guess that is one of the reasons, which is probably less a problem or less a focus in the US, because there are not really lots of public institutional investors. So I don't know how the pension funds and endowments look at that point. So that's one thing that I also see. The other thing is that in Europe especially, and that's, let's say, the market that we see more, you have the, again, EIF-backed funds who have a clearer understanding on how to report an ESG as well, which I think is okay, is good, but ESG, in my opinion, is always a little bit backwards looking, right? So what happened in the past and how do I report it? Whereas the SDG goals are really onwards looking, and it's more important in our opinion. So funds that show us that they have interest in SDG goals have that more in a, let's say, intrinsic way, right? And they are like more intrinsically motivated to be sustainable, to look at SDG goals, and to invest in those kind of companies. Another small things I think that we all see in let's say in the US as well as in Europe, like in all venture funds, in my opinion, is the trend to be more diverse, trend to invest in diverse teams, trend to not only gender diversity, but we identify a lot of diversity, regional, geographical diversity, ethnical diversity, national diversity, age diversity, educational diversity. So a lot of those funds that we speak to are interested to have a more diverse portfolio. A lot of those funds used technologies like Zoom even before COVID. So they are in a way much more, let's say, sustainable in their daily work compared to a lot of traditional industries. So that's what we see. We are still too small to really track that in detail for each fund that we look at or even invest in. It is sometimes impossible, for example, to push any US fund who has never really done a reporting on ESG or SDG to do that for us. I think there will be a general trend where everyone will adopt some kind of ESG or SDG reporting in the future. We are not able to push that, and we are not able even to push that on a portfolio level, because we have like 800 companies in the portfolios across the world, and it's just impossible. What we have thought about doing is to bring some transparency, is to use, again, technology, to use public data, available public data, to understand how sustainable our portfolio really is based on the public data. So you can understand, how many employees the companies have, where those employees work, how old they are, what gender they have, etc., etc. So you can, if they work in Copenhagen or in some areas, they are probably not a lack with or have a poverty problem. On the other hand, for example, we have a lot of companies in the Eastern European ecosystem, and we think that this even helps even more with poverty or jobs in that job creation in that areas, right? So you don't have the big banks or big industry companies paying 100K salaries in those regions, but you create companies like UiPath in a region like Romania, which employs thousands of people maybe today, and they create real jobs with real pays for those people. And that's something that we see. Again, it's not like perfectly trackable, and we're not good in green bashing, so we can't have a certificate on our reports to be green and pitch the pension fund and get money to do that with 20 million, 30 million fund. But we think that just naturally and intrinsically, many of our managers have sustainability as a goal and see that. And of course, the other big trend is that just many GPs have that really as a target, right? Written target in their decks, in the thesis, is that they want to be a sustainable fund, that they want to invest in sustainable technologies and climate, decarbonization, decentralization, etc. So these are the trends that I see.
And can I just jump in for 1 second? Just if that's okay. Yeah, I just want to say, I think one thing that we realized was when you're tackling ESG, whether you're a GP company, LP, um, it's easy to kind of get lost in the whole idea of like, okay, let's tackle every single problem we can on every front. And I think especially to when, as Ertan was saying, and sometimes you have a lot of capacity internally to be able to track everything, do everything. We're a team of 4 on the LP side, and we're managing a lot of things at the same time. So it's important to be kind of as pragmatic as possible. And at least that's our view, just to kind of pick a place where you think you can make the most impact and measure it in the short term, medium term, long term, and set yourself goals in each of those different quadrants if you had to put it in a matrix. So something as simple as like, okay, let's just track, I don't know, whether I sat in a deal flow meeting with a GP that we're working with, and the way they did it was pretty simple. They had Trello, their deal flow tracker software, and every time they had a company presenting or a company in there, they would either put all male or all female or mixed, just as a way to track gender diversity. That's not very difficult to do, but at least it gives you something, right? And so just starting with small steps like that can be helpful in kind of building on something as you go further down the line. But yeah, sorry, just wanted to throw that in.
Yeah, definitely. I think it is. It's like people get kind of freaked out about ESG. It seems like this really big, scary thing, but actually just trying to break it down, look at it like from those really simple, small components is super important.
And I think the other thing I'm very optimistic about is a bit like consumers changing their behaviors. I think a lot of founders now, millennials and other generation, have it front of mind. And the more founders push it to their VCs, and the more particular they are with the VCs they work with, the more particular the VCs will be to their LPs. And so I think generally, if we look at the world, the optimism is that the people actually receiving the capital are asking for this more and more. So I think even if there's no push or regulation or criteria, there's going to be a natural move across the industry for it. Just because that's the way this generation and next generation is.
I think we can also kind of link the ESG conversation to the conversation around emerging managers as well, right? So we're seeing so many more, female-led funds and funds with an impact mandate that are coming out of Europe. So I'd love to kind of I think we don't have too much time left. We can just end the conversation talking a little bit about, how can LPs just empower those new emerging GPs or work with those GPs? Maybe Jonathan, how do you see that emerging?
So I think the analysis we had last year suggested that 90% of those LPs that we surveyed were interested in emerging, and as I mentioned, 2/3 on the ESG front. So it's clearly a trend that is moving. I think if the question is how do we engage more LPs to invest in more of that asset class, I think it's difficult. I think we map something around 2,500 LPs that invest specifically into European funds. And I think if you look at the data, it's something like if you take the most active 20, that's 80 to 90% of the market, and then the rest there's a tail of over something 15 to 1,700 of LPs that have just done 1 or 2 investments. And so, clearly the market needs a lot of maturing, and, Ertan talked about some of the issues of the family offices. It's surprising that the majority of LPs out there have just done one fund, and I think it's just the case of, the VCs pitched them, they've got lucky, and they've convinced them to part with their capital. So I think the only thing that we can do is try and increase that graph to make it more of a normal distribution rather than this cliff, that beyond, the EIF, the BBB, the people we've got on the panel, and a dozen others. That's effectively we try and make it so that the population of LPs is actually much more spread out, which I think will solve part of that problem. But on the emerging fund manager side, this is something that we do a lot of work with And and actually, we find that the reason why LPs are so interested in them is because often, a lot of the data suggests that they perform better. I'm sure Ayrton's got lots of information on that. And the British Business Bank obviously produce in the UK, the biggest LP in the UK, produce a lot of information on this. So I think the data is there to show that the returns are there. But more importantly, I think it's about the hunger, the need to prove something. And the generation aspect. And I think you see that when you speak to emerging funds, they're out, they're networking, they're at events, they really try and they're building a brand. And so I think as a result of that, and we talked about the democratization of founders getting into VCs and the emergence of new funds, all of that I think will solve the problem naturally. So generally, I'm optimistic on ESG because of the founders and optimistic on the emerging funds because of the trends we're seeing and the general democratization of venture capital.
Ayrton, maybe we can jump over to you to talk a little bit about how you think that LPs can effectively engage with these emerging managers.
So again, I think I talked about it in the beginning about the sophisticated, unsophisticated, etc. But our long-term mission was really when I started in 2018 and left the family office I was working before, where I built my first portfolio in emerging managers. The idea was really to democratize the access to this to a diversified portfolio of emerging managers, which I think still most family offices or institutional investors are not able to do it themselves. And it's today, compared to 5 to 10 years ago, much more difficult to build that. Why? We have probably 10 times more emerging managers today raising funds. So if you want to screen those, you need 10 times more resources to screen those funds. We get like 10 decks a day. And that's our main job, to do nothing else than look at those and then speak to a few of them, build an opinion and select and do due diligence and invest. That is our daily job, right? For a family office, this is very difficult. And that's why I think, I still think, and I don't want to speak about the emerging manager part too much because that's, I'm always talking about that and the benefits, but in very, very short, as Jonathan mentioned, emerging managers are small funds which perform better, are investing because of that very early, which if you have the right companies in the portfolio early is just a much higher multiple. And third, there is what also we call hustler mentality. If you have a first fund and it's a small fund and you're not getting rich from the management fees, you hustle to prove that you are a good manager and deserve to raise a second fund, which might be larger, right? So these are the three things why we think still this is a niche that works extremely well. But it's also a niche that is extremely and transparent for most of the unsophisticated investors. How do you want to screen 1,000 new funds every year? It is impossible for most of the family offices. And that's why we think it's not an asset class like other asset classes where it's easier to get that kind of access. And it's also an asset class where you can do things wrong. It's not like that all funds will perform evenly, right? We don't have that even distribution in venture. It's completely the opposite. You have a few funds that will distribute a lot or generate a lot of returns, and many or most of the VC funds will not generate any returns. So for a family office or an institutional investor who wants to do that themselves, without having the understanding and the resource and the people, the probability of adverse selection is very, very high. And that's something I think I'm doing this now almost a decade. I've started investing in 2012, 2013. It's now 2022, and I still see the same problems or same issues accessing that asset class, especially in Europe. It's still like people are not convinced, we should not only invest if I'm based in Germany, only invest into 1 or 2 German funds. And if I'm in the UK, only invest in 1 or 2 UK-based funds. That's not the case. If you want to really do venture and emerging manager venture, you have to go into other regions. You have to try to get deal flow, from Eastern Europe, from Baltics, from the Nordics, from Southern Europe. I'm only talking about Europe. And then do your bets in each of that region. Do your bets in each vertical. We talked about climate. We have not talked about crypto. I think crypto is one of the best performing venture verticals in the last 3 years. So if you have not deployed into that area, you have missed a lot, right? From that super returns. And that's the kind of thing, and maybe the last thing that I want to mention that is always forgotten is we are probably in one of the best times for venture. And we have seen one of the best decades in venture, especially in Europe, probably the best decade ever in venture. This will not stay the same all the time. So venture, as other asset classes, will be cyclical, right? So we will see also worse times. And so what we always recommend to anyone allocating into venture is think super long term. Don't try to market and time that this ecosystem, because it's almost impossible to time it. You can't do like just because you see today everything is going well. Venture is a long-term game. If you invest today, you have to wait 5 to 10 years for exits. So in 5 to 10 years might be completely different scenario. So what we say is invest for the next 2 to 3 decades to allocate into that ecosystem. And I'm not reinventing the wheel. If you look at Yale Endowment, which is like very famous, for their allocation over decades into venture, that's how everyone should think about allocating into venture. If you're a family office, if you have money, allocate 5 to 10% over 3 decades into venture, and I promise it will be probably a very good asset class compared to other asset classes long term.
Strong pitch, Ertan. Ian, maybe you can close us out by just telling us a little bit about how you see the emerging manager question.
Of course. So, and although we've performed that analysis ourselves around the data of performance of first-time funds, it's clear that they outperform relative to the rest of the benchmark. But also, it's important to highlight, I think, that in that data, the variance around the mean is greater. So the chance of you investing as an LP in a manager that is emerging and it going worse than you would see around the mean is also, the extremes are greater, is what I'm trying to say. Mm-hmm. So it's important to still have that kind of clear ability to pick managers based on a couple of things, right? So the way we do it when it comes to emerging, and our, for total clarity, our emerging manager program on our side is it's fairly underdeveloped today, and for a lot of reasons we're kind of like a startup ourselves in a way, and we've had to build our portfolio by focusing on certain things. But where we have actually engaged with emerging managers, the question is always, the first question we ask is like, what is your, is there a track record there, for instance? And it doesn't necessarily have to be through being in that particular fund, right? You could be a prolific angel investor who's done a lot of different things before you started up this fund, or you maybe have worked with a fund before, and while you were over there, you were doing lots of really interesting things. So those are the kind of questions we ask. And if that's not there, for us, it's typically a little bit harder to get comfortable because there's just no data, right? There's no proof points. But there's other things you can think about. So, for instance, what does that manager bring to the table that we cannot find in other places which already have those proof points? So again, coming back to the USP point, what is their unfair advantage? And if you're a seed investor, for instance, that might be your operational experience. Maybe you've done some really, really interesting things in the past where, maybe you were some very high up person in Google and you have an incredible amount of access to through your network there. So looking at networks, looking at, their past operational experience may be really, really valuable. And then, if there is kind of a, let's call it a track record in the past, it's just kind of seeing whether they had that manager, that ability to consistently pick things that delivered outsized returns over time, even as an angel, even as just a principal in another fund. So forming a view on those things we think are really, really important. I just want to touch a little bit on the point that Ertan was talking about, and John earlier, about kind of the educational point around LPs not fully understanding the asset class. Whenever I sit on advisory boards and listen to what people have to say, often when you hear family offices speak, sometimes the first thing they'll ask is like, okay, when are we getting our cash back? And I think when you invest in venture, you really, really do have to take that long-term view. Investors are used to, so a lot of people are very focused on IRR, getting their money back as as quick as possible, but that's not how this works. And so for you to actually reap the benefits, whether you invest in emerging managers, established managers, all those things, at the end of the day, you need to be in it for a long term, and you need to put money in consistently over time. And I just want to stress how crucial that is. Don't expect your own money back in 3 years. It's just not going to happen. So, yeah, I thought I'd just kind of reemphasize that point.
Sage advice. Well, I think we're out of time, but thank you so much to all three of you for your insights on this topic. I definitely learned a lot, and I hope everyone enjoyed the conversation as well. Thank you so much, Ian and Erton, for joining us from virtually. Thanks so much, and
Thank
thank
you
you,
very much.
Jonathan. See you
Thank
guys.
Yes.
Thank you very much.